Welcome, everyone. I'm going to give just a minute for everybody to cycle in, and then we're going to get started. All righty. Hello, everyone, and welcome to the Estate Tax Apocalypse. We're glad you joined us this morning. Now, before we get started, we just have a few quick housekeeping items. This webinar is going to be recorded, and you'll receive the recording link emailed to you later today, along with contact information for our speakers. So be on the lookout for that in your inbox. This webinar is going to run 50 minutes with 10 minutes Q&A at the end. So if you have a question for Harry, please put it in the Q&A box located in your Zoom toolbar. To find your Zoom toolbar, just hover your mouse over the top or bottom of your screen and it'll pop up, and look for the Q&A icon. All right, now I'd like to introduce our speaker. Harry Barth is the founder and senior managing partner for Barth Calderon, LLP, and is the author of the book Planning Today for All Tomorrows. He is a nationally recognized speaker on estate, business, and asset protection planning to many incredible organizations across the country, including Vistage International, Women's President's Organization, Young President's Organization, Tiger 21, Quaker Oats, Entrepreneurs Organization, California Society of CPAs, and many more. Harry has over 40 years of experience counseling business owners and their families, corporations, and franchisees nationwide. Harry has distinguished himself by being an asset protection advocate in his workshop, and his workshops have helped thousands of families and businesses protect their assets they have worked so hard to build. All righty, and without further ado, I'm going to hand it over to our host, LSL partner Dave Myers, to get us started.
Thank you, Jill. I'm Dave Myers. I'm a tax partner here at LSL, and I enjoy helping you save on income tax and estate tax. And first off, I want to apologize. I want to apologize for the apocalyptic language in the promotion of our webinar here. This was intentional clickbait to get your attention to come over here and hear what we have to say. And I think, well, unlike all the other clickbait you get, you won't be disappointed that you clicked on this one. The reason is that this topic is very important. Millions of dollars of your family wealth could be at stake. And our speaker, Harry Barth, is going to give you some valuable insights and motivations to move, and move soon. I have worked with Harry on many of my clients. His expertise and guidance has not only preserved wealth for my clients' families from the taxing authorities, but his planning also includes protecting that same wealth from other creditors besides the government. So without further ado, Harry, take it over.
Oh, thank you, Dave. It's great to be here. Thank you, Jill. Thank you, Cami. Good to be here with LSL again. Wow, do we have a lot to talk about today? As Dave mentioned, the title of our workshop this morning is the Estate Planning Apocalypse. So the one word that we'll say to begin with is vigilance. Vigilance is very, very important. And what we're going to talk about today is not politics per se, but what happens here is highly politically motivated. So let's go a little bit and talk what happened about, about 2016 or so. We had the tax cut, the Jobs Benefit Act that went into effect. And in that legislation, there was the historic increase in the size of the federal estate tax exemptions, which currently sit for a family of about two spouses at $27 million. What that basically means is that myself, my wife, were able to pass $27 million worth of our assets to our children without the impact of a federal transfer tax. And that federal transfer tax, as it sits today, is 40%. Now, 90% of Americans don't have net worths over 95% of over $27 million. So they didn't think that very much planning had to be done. The understanding also that we always understand is that we, Harry, my wife, you, your spouses, we will never pay estate tax. It's the cost of transferring our assets from one generation to the next. We need to understand a little bit about why the estate tax. So when the estate tax first came to play, ladies and gentlemen, it was to finance the Spanish-American War. Oh my God. And it affected, I don't know, 15 families in America. But today, the estate tax, the government spends a lot of money in collecting estate tax, but they don't make any money with it. So why do they have it? They have it because we'll call it the left-leaning aspects of American politics believe that wealth should not concentrate in the hands of a few families. Kind of an anti-capitalistic approach, and one of the best ways of diminishing wealth in families from generation to generation is by imposing a significant tax on that wealth. Hence the estate tax. We can also call it a transfer tax. The impact of politics. The historic 27 million for a couple, 13.6 million today for an individual exemption was put into place. Politically, there was not enough political capital to make it permanent. So they were able to use a couple of provisions in the law that it's called budget reconciliation, but they couldn't override a Senate filibuster. So the net result was that that legislation lasts until December 31st, 2025. And what Dave was referring to earlier is what happens when we wake up on January 1st, 2026. Well, by autopilot, unless some intervention by government takes place. I want to talk about that intervention. When we wake up on January 1st, 2026, assuming we're still here, that exemption of 27 million is probably more likely than not going to drop by autopilot to $12 million. And which is, by the way, a very simple calculation at 40%, a $6.4 million increase. I repeat that, a $6.4 million increase in the transfer tax moving from generation 1 to generation 2. Now, differing from most other tax legislations that we've had to deal with in the past, this is an automatic expiration, meaning that let's examine this politically because we have to. And this is not peaking politics. Please understand that. So if we have mixed government, so we'll call it perhaps a blue or a red White House, and we don't have all blue or all red in the Senate and the House, that means that it takes all three to make this happen, to make a change, that more likely than not, the event will occur, that we will drop from the 27 million to the $12 million. If we have all red White House, red Senate, filibuster proof, and red House, more likely than not, the present schematic of our state transfer tax system, the 27 million adjusted for inflation, will continue and has been talked about to become permanent in congressional terms. Who knows what that really means? We also know that, and I think Dave is going to be having a seminar about this coming up in the future, that if we have a blue White House, blue Senate, and blue House, that the proposals of the Biden administration are as follows: that exemption will be brought down to $7.5 million, about $3.7 million per person. The transfer tax would then be up between 50 to 55%. So with that could be, confiscatory. That's truly apocalyptic. I don't expect that will happen. I don't even think that the blue politicians would have the gumption to raise that confiscatory tax rate to such a level. But it is what it is, and I needed to give you that lay of the land. But we're going to work today on the more likely than not expectation that it's the estate tax exemptions are going to drop from that 27 million to $12 million. So the impact on everybody could become quite significant. And we're going to talk about some of the things that we can do now that really should be evaluated by everybody. So I think evaluation of our estate plans, evaluation of values in our estate plan, of truly come of time. And we're limited, ladies and gentlemen, with our runway. I mean, we can't do this in December of 2025. All of the things that we're going to talk about today take significant time to implement on behalf of a family. So what are some of the things that we can do in the time that we now have? So I think before we get to what we can do, let me talk about one other insidious problem that we have. So a lot of people look at their net worth and they got a small business, they have money in retirement plans, and retirement plans are going to be potentially really significantly impacted. Let me pause for a moment to talk about that, because if we have money in a 401k, defined benefit pension plan, IRA, simple IRA, any qualified plan, ladies and gentlemen, you haven't paid tax on that, state or federal, yet. So that particular asset, my God, if we are over the $12 million if married or over the $6 million if single, will be subject to federal income tax, subject to state income tax, and subject to federal estate tax. The tax impact on a retirement plan, like $5 million in a retirement plan, could be 60 to 70% off the taxes. So boy, does that also give us a planning opportunity as to what to do about that. But what I was concerned about here is that we have many people. I mean, I'm doing this for almost 50 years and across 5,000 clients, and we look at it, and they may have a net worth that clocks in around $8, $9, $10 million all in. Remember, it's everything. It's everything we have. It's stock options, it's stock, it's pension plans, it's houses. It's every single thing we own. And in California, houses have significant values as well. It's not that difficult to reach over the estate tax threshold. But the one that's highly concerning is a remedy and also a problem is life insurance. So we see so many people that have bought. I said, "Do you have life insurance?" I asked them, they say, "No. I have term insurance." Term insurance, ladies and gentlemen, is life insurance. And they'll have a $5 million term policy or a $10 million term policy for 20 years or 15 years that they have. But they don't recognize, and they are the owner. So Harry buys a $5 million life insurance policy, and I'm the owner of that policy. Life insurance becomes cash, guys and girls, in the event of death. And since I am the owner of my life insurance policy, although my spouse or my living revocable trust may be the beneficiary, that $5 million is also included in my estate. So if I'm a single guy, all right, and my estate's over $6 million, or if my estate's $4 million, add $5 million, and I now have $9 million estate. And if I have a $6 million exemption, I have $1.2 million of taxes to pay that is caused exclusively by the life insurance. I would probably say that 3 out of 4 examinations that we have done recently and diagnoses of families, estates, will find that a large life insurance policy that causes the estate tax. So one of the remedies, but I say both a problem and a remedy. So one of the things that we can do, and which is easy, relatively inexpensive to do, is to examine life insurance, term insurance, universal life insurance, whole life insurance, and get it out of the estate. We could do that by the creation of life insurance trusts. by creating dedicated life insurance trusts, which are relatively inexpensive and not very complicated, and moving the life insurance into a life insurance trust, assuming we live 3 years from the time of that transfer, we are able to remove life insurance from the estate. And if we got $10 million worth of life insurance, $9 million worth of life, that's $4 million worth of taxes that we have removed from the estate. So when we're examining an estate, or you're looking at your estate, don't fail to include the value of the life insurance, because more likely than not, it's included in your estate. Now, that wasn't so much of a problem when we had $27 million worth of exemptions for a family, but it does become significantly a problem when it drops down to 12 million, should it drop down to 12 million. So this is an opportunity. The second opportunity, talking about life insurance, is that we can purchase life insurance to help pay for the increased federal taxes. So if we have anticipated federal taxes of $3, $4, $5 million, and what's the problem? Sometimes our net worth is comprised of real estate, businesses, maybe non-liquid assets, right? And we have to come up with, $4 or $5 million to pay transfer taxes to on our estate in order to transfer things to our children. This is problematic, because what happens to us, if you think about it, I don't have the money. I'm not going to be able to borrow the money at that time. So it's forcing me, which is, by the way, the goal of the government, forcing me to sell either my business or sell off my real estate that I'm trying to move to the next generation in order to pay the taxes. So a lot of people take the opportunity, bite the bullet, create some life insurance trusts, buy some life insurance. If you buy life insurance in a life insurance trust, there's no 3-year wait. And now we have the liquidity needed at the appropriate time to pay the estate tax so it can move through to the next generation. It's one of the easier, simpler methodologies, but we have to have the health in order to be able to buy the life insurance. We have to have the current ability to pay not usually an inexpensive premium along the way. The life insurance trust, or the legal way of holding it, is the least of our concerns. Other people, and when we start dealing with the apocalypse that's coming, take the attitude, which is not necessarily right or wrong. They don't care. They say, "Hey, look, we're dead. We work really, really hard. We built our estate. No one helped us do it. I'm not, a big fan of leaving a large amount of money to our children so they can become trust babies. We don't care." So for people that don't care, well, then 40% of it will go to the government. They're in the minority. But it's not just the 40%. Remember, like I said, what if it's not liquid? What if we have just real property and businesses? The business could be destroyed, absolutely destroyed. Again, a goal of the government to get that done. Another thing that's done, or another methodology in dealing with taxes, are for families that are philanthropically inclined, like my family. And we could do something that looks like this. We can create an estate plan. Again, all of these are very, very high level today, ladies and gentlemen. It requires a lot more facts and a lot more weather. So don't take any of this as applicable or appropriate for you without proper professional counsel. But we could do something which is known as an over and under estate plan, but basically say, hey, look, what's ever subject to federal estate tax goes to a private foundation, the Harry and Tess Barth Foundation. Anything that's not subject to estate tax goes to my children. My children could serve on the board of my charitable foundation and do good things in the world because I've been successful, and I don't pay any estate tax. So there we go again. So another methodology that's not irrevocable, relatively easy to establish for families that are philanthropically inclined. So what else happens or things that we could think about? And I think it's really important to think about this because you have a couple of factors that are involved. I am staying away today a little bit from my favorite topic of asset protection, but it's critically important because this is part of asset protection. So one of the other things is that, what about, we have $27 million that are available to a family today, $13.5 million for an individual. What else can we do? So let's talk about one of the other things that we do. The goals now, we're now shifting away from the charitable thing that happens at death. We're shifting away from the life insurance that happens at death. And we're shifting more to how do we capitalize, which is we'll call it the main element of today's time together, on moving our assets from now to our children and to our heirs. I think it's important to understand that we do have the $27 million now. Okay, assuming we got the life insurance out of the estate into the life insurance trust, we have $27 million. And how can we capitalize upon that? So one of the things that we can do for those with much larger estates is work on actually gifting today, because we have not only a $27 million estate tax exemption, it's also available to us during lifetime. We can create trusts for the benefit of our children, and we can gift assets today worth $27 million to our children and lock in the $27 million exemption. So if we do that, we'll talk about the issues associated with doing that. What have we gained? We've gained a few things. So we've locked in the 27 million, which is worth, ladies and gentlemen, $6.8 million in the family's pocket. That is big, big, big bucks. In addition, things we have to think about, hey, we're not dying on January 1st, 2026. What about the growth of our business, the growth of our real estate, the growth of our investments over the rest of our lifetimes? What's $27 million today could be $40 million tomorrow. If we make a $27 million worth of gifts today in trust to our children, not only do we lock in the $27 million and save $6.8 million worth of taxes, we also get all of the appreciation on those assets out of our estate. We've been doing these types of transfers for 2 decades. Some of our clients transferred $14-15 million worth of assets 15 years ago that today are worth $100 million. Okay, in those trusts, saving $40 million worth of estate taxes. Now, it does become problematic in some respects. One is, how could we do this and still have some modicum of control? And what about our children? What if they have problems and issues and spousal issues, creditor issues, business issues? Are we just kicking the can to a scenario that may not be as safe as our own scenario? Hence the use of trusts for the benefit of children. So in using trusts for the children, it keeps it separated from their spouses. We can put in rules and regulations. We can build LLCs inside those trusts, so a fair degree of control could still remain at the parental level. And people are happy about that. But of course, all of the income gains on those transfers now belong to the children and not to us. In some estates, that's perfectly fine to take advantage of that. But we do need to make sure that in the assets, so for example, if we have a business, maybe we turn that business into voting and non-voting shares, and non-voting and voting membership interests of an LLC. We get them valued today, which we can do and get discounts. We'll talk about discounts in a few minutes, and make gifts of those non-voting interests or some of the LLCs that hold our real estate into trusts for the children and lock in the 27 million or 25 million or 24 million before it evaporates. Not a bad thing to do, assuming that it's appropriate, proper for the family. It fits within the family's culture, the family's traditions, and the family has enough remaining assets and income in order to continue to live the lifestyle that they're currently enjoying. So we have that. Now, we have some time bombs associated with thinking of that for those of us that own real property in California since Proposition 19. Now, if we transfer California real estate or gift California real estate to our children, greater than 50% of the value of the LLC that it should be incorporated in, the property will be reassessed. Sometimes we have, if there's any financing on that property, we might have some difficulties with a lender. We need to get lender consent. Sometimes with the insurance marketplace that we're looking at in California, we sometimes have a difficulty getting insurance, but most of those obstacles we have been able to overcome significantly in making the transfers to the next generation. And just but way beyond today, there are still opportunities where we are able, through certain very, very technical procedures, that we are able to transfer California real property to the next generation, get it out of our estate, and at the same time, if the stars are just right and we work very, very carefully, to be able to do it in a way that the children be able to keep the property tax basis that we currently have, and it will not be reassessed. This is a grand slam win, and very, very technical, and not a little beyond the time that we have available today. So is that good to transfer to children in appropriate families? The answer is absolutely yes. There are other things that we can do to freeze the value of estates. We can make we could sell real estate and business interests to a trust that we've created for our children, hold on to promissory notes. This is called, in legal terms, a sale to an intentionally defective grant to a trust, blah, 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 blah. But what basically happens here is that we take properties and businesses that have tremendous appreciation value, we sell them to a trust, and we take back a promissory note. If we do that properly, something we call a grant to a trust, there are no adverse income tax ramifications in getting that done. And what that allows us to do is our promissory note that's now in our estate. So I turned a $20 million business into a $20 million promissory note. That's not going to appreciate in my estate. And the $20 million business will appreciate in my children's estate. And every dollar of appreciation that I move to the next generation saves 40 cents in taxes. Another thing that needs to be evaluated carefully in estate planning. Timing, I'm going to talk about the granddaddy of recommendations in a few moments, in trying to avoid the upcoming estate planning apocalypse, is some things that need to know. All of these procedures take time. It may seem a long way till December 2025. It's not. When we're making transfers from parents to children or to other trusts, we need to get valuations, formal valuations of those properties. If we're looking to get discounts on valuation, we need to have proper and professional valuations. There are gift tax returns that need to be filed. There are lots of things that have to be done, and a tremendous amount of pressure on professionals that have the skill sets that are necessary to be able to help you make this transition. Vigilance is the word, analysis is the word. To me, and before we get to one of the major recommendations, eyes wide open rather than eyes wide shut. None of these things that I'm talking about may be appealing to the family. But what you should know, and what LSL and Dave and other professionals are trying to let you know, is that each of these should be evaluated, should be looked at. What are the ramifications for my family? What's the size of my estate? What is the impact? What is the impact of future growth of my assets? What is the impact on the culture and traditions of my family? Is this a time to deal with this? Yes, it is. All right. All of these things should be looked at. At the end, you may turn around and say, hey, look, I'm just going to wait it out. Maybe the government's not going to change it. Maybe I'll just buy a life insurance policy. Maybe I'll just give it all to charity, whatever it may be. But we have fully and fairly evaluated it. And I think that is absolutely critical. So let's move along a little bit. And let me talk about one of we'll call it the granddaddy of recommendations that many families are taking advantage of today. And I think I will try to make this as simple as I possibly can, but it's the use of what we call non-reciprocal spousal lifetime access trusts. So that's, again, a big mouthful of legal terminology. And so let me start by letting you know the benefits of that. And then we'll talk about the detriments of that. And then we'll talk about logistics of that, should it be something that's in the cards for yourself and your family. So benefits. Well, the benefits are that if we engage in, if we have, we need to have spouses for this. So we need, this is primarily oriented towards married couples. For single individuals, it's more of the gifting, more of the life insurance, more of the charitable stuff that comes to play, gifting to children with all the proper bells, whistles, and restrictions. But the spouses, we grab an opportunity here. It's an opportunity that is going to evaporate, but an opportunity that is here and now. I could also tell you that in the last few years, my firm has completed well over 150 of these types of trusts for our clients successfully. So what is it? So benefits. One, we are able, ladies and gentlemen, to lock in today the $27 million worth of exemptions. So when we wake up on January 1st, 2026, the Smith family, who created these non-reciprocal spousal lifetime access trusts, has locked in the 27 million and has saved initially 6.8 million. It's a lot of money, you know, to move the assets from one generation to the next. I want that to sink in. That is an awful lot of money. You may think of it up at your level. I see it also on the children level when they turn around and say, we don't have $6.8 million. We don't have the liquidity to do this. We're forced to destroy that which my parents have built. All right. And then they say, well, why didn't my parents do it? Sometimes it seemed overly complicated. All right. It seemed overly costly because sometimes we lose track of the fact that it's really $6.8 million. And there are very few things that you could do in your life and in your business even that's going to have a $6.8 million positive impact, assuming that the apocalypse happens on January 1st, 26, which is more likely not than it will. So we get that benefit. The second benefit that we get in non-reciprocal spousal lifetime access trusts is that the growth on that $27 million worth of assets. And by the way, we could do this with 20 million, 19 million. We could do it one-sided rather than non-reciprocal. We can have transactions with the trust. There are a lot of things. I'll try to fill those in if I get a few moments towards the end. But all of the growth, so if that 27 million over the course of a lifetime grows to 50 million, 55 million, 60 million, which more likely than not, it will, even at a simple 3.5% to 4% growth rate, that will also escape to future federal estate taxation, $16 to $20 million worth of tax savings for family. That's significant, no matter what the politics may be at the time. So we should take a look at it. And then, near and dear to my heart, all the assets that we have placed into these non-reciprocal spousal lifetime access trusts will be asset protected from the claims of creditors, both for each spouse. Asset protection, even in California, estate appreciation, and locking in the $27 million. Okay, so what has to happen? How do we make that happen? How do we make it work? Well, I think the first thing we need to do is we need to decide whether this makes some sense. Now, we're actually doing is we're using up our death time exemption during lifetime. And I'll use it in terms for myself, because I've actually done this, and maybe you can interpolate that for you at least momentarily. So what happens is Harry created a trust. First, I took Harry's, let's say Harry had $30 million worth of assets. And because I'm in California, it's all community property. And so I had to change the property to $15 million of separate property for Harry and $15 million of separate property for my wife, Tess. Relatively easy to do by signing what we call a transmutation agreement. So I signed a document, my wife signs a document. Now, instead of having $30 million of community property, we each have $15 million worth of separate property. And then Harry makes a gift to a trust for the benefit of my wife, Tess, of my $15 million. So I take my $15 million, we got Harry's trust for the benefit of Tess, all right? and I transfer $15 million or make a gift of $15 million to her. And my wife will create a trust for the benefit of Harry and transfer the other 15 million of her separate property for the benefit of me. Okay. So we picked $15 million worth of assets that are now my wife's separate property. She makes a gift to that trust for the benefit of me. Let's examine that trust on that level. It's what we call a grantor trust. There are no income taxes associated with this. No income taxes in the transfer, no additional income taxes, not even a tax return that needs to be filed. Harry is the trustee and the beneficiary of that trust that was created by Tess for the benefit of me. Hence, ladies and gentlemen, the control of that trust vests in me. It's for the benefit of me during my lifetime, for my health, education, welfare, and maintenance. And upon my death, the pile of money that's in that trust will then move to my 2 children in trust for the benefit of them, income tax and estate tax free. I have complete control over the trust that my wife established for me. If my wife's in a car crash, creditors can't reach those assets. If I'm in a car crash, it's a trust that was created by somebody else for the benefit of me. Creditors can't reach those assets. All the growth on that 13 million that my wife transferred to me, whether it's 20 million, 25 million, 30 million as I grow older, will be exempt from federal transfer taxes upon my death. And at that time, it transfers to children. Spousal lifetime access trust. My wife Tess's access to that pile of money that she granted to me is through me, her spouse. So if she comes to me and says, Harry, I want you to take $300,000 out of that trust, okay? And we're going to use that. I want you to take that money so you can take us on a trip for our 55th wedding anniversary to Monaco. You know, I was also 55 years married, 10 of them happily, as Henny Hungman used to say. And we do that. And so she has access through those assets through me, spousal lifetime access. This has not yet been transmitted to the children. So we now have control back up on the spousal level. People are a lot more comfortable with that. In addition, all right, I can substitute assets. She can substitute assets in and out of that trust. She can sell additional assets to that trust. And those assets in that trust are protected from estate taxes, protected from future growth. We also made trusts for our children that come as part of that. So upon my death, it goes into an irrevocable trust for the benefit of my children. So they're all protected as well. Pretty good. All right, we identify the assets, we get them valued, we get any discounts that are associated with it. We move those assets into a trust, and then Dave and his team file gift tax returns, locking in that $13 million. Great, works good. We can do that anytime, and we do not necessarily have to go to the other non-reciprocal trust, but I'm going to explain it to you. Because here we have a little bit of a wrinkle that's associated with that. So that's pretty easy to get that done. Not a lot of downside, not a lot of problems. That transfer is not a reassessable transfer for real property under Proposition 19. We usually have no problem with insurance companies and rarely, if ever, any problems with lenders associated with that. Now, the other side of this is that if I just made a mirror image on the Harry transfer to Tess trust, all right, if it looks exactly the same, the federal government has a doctrine which is known as the non-reciprocal trust doctrine, or the reciprocal trust doctrine, which basically says that if they look exactly alike, they're going to just disregard the whole thing and put the whole thing back in the estate. So in the hands of a craftsman, when I set up the trust of my gift for the benefit of my spouse, and this can go either way. This is not a chauvinistic statement. I need to make it a little different. I will have, instead of my wife being the trustee of the trust, I'll have her be the investment trustee or the disbursement trustee. I'll have a different trustee as the trust. I will set her trust up in a different jurisdiction. My trust may be in California. Her trust may be in Nevada. I will turn around and make a different disposition for my children upon my death. There's a lifetime distribution to my children for the whole trust for life. Maybe on her side, I'll have a 3-stage distribution at 30, 35, and 40. They will not look the same, so as we not avoid the reciprocal trust doctrine. By doing that, getting a proper valuation, making the appropriate gifts, we are able to lock in her my $13.5 million that I have now gifted to my wife. So my family, which is really good, we have a $27 million exemption. All the growth is exempt. Everything is asset protected. But we have really good control. Even in my wife's trust that I created for her, I formed an LLC that holds stocks, bonds, investments, and different LLCs that hold real estate that I'm the manager of, because my wife would like me to continue to control those things on behalf of the family because of my particular skill set. And that works out very, very, very well. So that is, in many cases, for those that have larger estates, a very, very, very strong recommendation. A couple downsides associated with it that we need to understand. There are about 3 of them, maybe 4. So let's go through the 4 downsides, and then we'll do questions and answers. There's a very big subject area in the time that we have. One is that it's complex. It takes some time. It'll take us 6 months to do it. We have some expense that's associated with doing it, but the net result is usually very good. But the logistics of doing it, this is not as simple as a living revocable trust that we've done for our families. 2 is what happens if my wife divorces me, which, can happen any other day of the week. Well, my access to the pile of funds that we had given to that Harry gave to my wife Tess, and she divorced, I would no longer have access to, because if I asked for something, she would tell me no, if she was even talking to me whatsoever. However, under California law, had we gotten divorced, absent a premarital or postmarital agreement, it would have been 50-50 anyway. So c'est la vie. If their business is interested, I'll probably buy the business interest from the trust, get a promissory note, and move on. That usually is not a detrimental impact. What is a detrimental, or sometimes a detrimental impact, is what happens when a spouse dies. So if my spouse dies, so my spouse predeceases me or I predecease my spouse, then my wife's $13.5 million and whatever it's grown to, maybe $20 million, whatever it may be, will now move to the trust for the benefit of my 2 children. So my spousal lifetime access through my spouse is no longer there because I've lost my spouse. So now maybe I can borrow some money from the trust for my children. Maybe I could provide some management services to the trust of my children. Maybe I don't have a good relationship with my children, and my children will not allow me to have any access whatsoever, but I am successfully move those assets and all its growth to the next generation. Hence, wouldn't it have been great if I had my wife's spousal lifetime access trust apply some life insurance on her life with me or my trust as a beneficiary? So when my wife passed, if she predeceased me, or if I pass, for my wife, there is a bundle of liquidity that can go, if necessary, in many cases not necessary, to help my wife along the way, assuming that there is a rotten relationship with the children. Most families or most things as far as estate planning is concerned, if we have a great relationship with children, we're able to beat the tax man at his game. So you have death as a consideration, we have divorce as a consideration. And as Dave will point out, one of the other things we lose is what is known as a step up in basis, because none of these assets will ultimately be subject to federal estate tax, so they don't get a step up in basis. Under some of the government's proposals, they're looking to eliminate a step up in basis on death. Hopefully that won't happen. But when I compare a capital gains tax, even in California at a 33% rate, which happens on the sale or an equity event of an asset, versus an estate tax, which is 40% and happens 9 months from the date of the second death, and there's no equity event and no money to pay it, I think the estate tax is much more draconian than is the capital gains taxes. In addition, if I have some life insurance, I have money to pay capital gains taxes. And in addition, I would have been able to buy some highly appreciated assets from my wife's spousal lifetime access trust and giving them a promissory note, bring them into my estate, and therefore getting a step up in basis. So there's some ways around that, assuming that they don't change the law. So there are a lot of, we'll call it nuances and things that we can do with the flexibility of all of the strategies that we've talked about today. What we can't do, okay, this we cannot do, ladies and gentlemen. We can't become ostriches. We can't stick our heads in the sand and say, let's not look at this. I implore you, Dave implores you, LSL implores you, but Calderon implores you, please, please allow us to take a look at your situations. Let us explain the ramifications. Let us explain the options. No one's going to put a gun ahead to your head to do anything that you're uncomfortable with, but at least you should have eyes wide open and not eyes wide shut. I do hope that we have some sanity in our government, that the current exemptions stay the way they are. That is a possibility, but we need, so it's the old story that I say, I plan for the worst and hope for the best. And with that, I think you guys have a very, very good understanding about what's coming or potentially coming, and a series of options on a high level for your consideration. And with that, Jill, Dave, let me go back to you guys to do some questions and answers. I think we are right coming up on our 45, 50 minutes, and hopefully we'll be able to answer questions if we have any from our audience.
I don't have any questions right now.
Actually, Dave, I see one popped
Oh,
in.
one question.
Yeah,
Okay,
one just popped up. Let me know if you
Med-
can't read it and I'll read
Yeah,
it.
can Medi-Cal recover from assets that were in a revocable living trust? And it's kind of a little off topic.
Yeah, but the answer to the question is under new California law, and only in California, this has nothing to do um, with other states. A primary residence that is in a living revocable trust and not a probate asset, Medi-Cal cannot recover from. And if we have any other questions, if we have no other questions, I think Jill, if you could let everybody know how to reach Dave, how to reach me, so we can continue to have this conversation, and we look forward to that with everybody.
And I had a question.
Sure, go
couple
Dave.
questions. So in Biden's proposal, there's no attacks on valuation discounts, nothing explicitly listed on that, and also the use of defective grantor trust and the type of trust that you described today, the SLAT. But in all the other, there's other legislators and presidents, and it's always coming up. And what's your thoughts on that and the political winds and the importance of doing the SLAT arrangements while the going's good?
Yeah, so that's a really, really, really good question. And so let me try to tackle that. The Biden's Green Book proposals, which of course are not a bill, not been submitted, may never become a bill, but we did have the Senate Finance Committee bill that was actually submitted in 2020. And in that bill, intra-family discounts were eliminated, and the utilization of grantor trusts were also eliminated. So what happens you have president's proposals, and then those are added to by various different senators and or Congress people, and it becomes a hodgepodge of stuff. Intra-family discounts or discounts from one generation to the next within a family have been the subject of a lot of talk in Washington over the last 20 years. They have not been eliminated, as they have been a bird of the courts and not a bird of the legislative branch, but they're always in question as far as I'm concerned. So I think now the going is good, and now it's a great time for planning. As far as grantor trusts are concerned, it's the same thing. Sales to defective grantor trusts or grantor trusts. And for our audience, if you don't understand, these are types of trusts that are very, very income tax favorable for if they're effective for making a transfer to the next generation, but do not have any negative income tax implications associated with them to a great degree. They have also been called into question, as Dave brings up, there's nothing on the horizon at the moment, but that doesn't necessarily mean that there won't be. If we have a blue scenario, I think we see all of these things come back into line. I think there's
We
some
do have
questions
a
maybe
couple.
in chat too.
Yes, I see
Yeah, we
one.
had a couple more questions in chat. Is it possible to talk more about Prop 19 and just kind of,
I think they were
yeah,
talking about Prop 19 in another
okay.
presentation, but let me give you a high level answer on Prop 19. It used to be that we were able to transfer primary residences and a certain amount of real estate to the next generation without property tax reassessment. Since Prop 19, that's just been awful. So people that have bought homes for $1 million and now with $4 million, they now try to pass those properties on to children. And now, even if we bypass the estate tax, they are subject to new property tax valuation based upon fair market value of $4 million. In commercial building, it's even worse. We've seen commercial buildings people bought several years ago for $4 million, and now $40 million. All right, the property taxes on that would go up, 40 times. Really, really bad. Are there tools and techniques that we have now that would allow us to potentially transfer low property tax basis properties to a next generation while keeping the parents' original tax basis? Is something which is known as the Dell exception. It's a multi-stepped, multi-month process, but under the current law, that is still possible. But we need all the runway that we have now. The whole genesis of Prop 19 and how to get around it could be the subject of another workshop and seminar.
Thank you. Another question, will the annual gift tax exclusions change? And I don't think I'll answer. I don't think that's going to change. That's statutory and it's not set to expire, right? So
That is correct. The current is $18,000 per person for any number of persons. The proposals come in a different way. There's some of the proposals that we have seen from the government is that instead of it's $18,000 per person with an unlimited number of people, it may be $18,000 to a limit of $50,000 in total in any one year. So a limitation on that. So there's talk of that's rolling around. I haven't seen if we have the expiration of the Trump era tax exemptions. I, like you, do not believe that $18,000 a year adjusted for inflation is going to move backwards, but I think they may attempt to put a cap on it.
No more inflation adjustment or?
Well, one of the insidious aspects of that is that in the proposals that were made, when they talked about rolling back the exemptions to the $6 million, see, right now the exemptions are adjusted for inflation. In the rollback, it still is adjusted for inflation, but in the Senate Finance Committee and Biden proposals, they're not adjusted for inflation. So which is another tax along the way.
Mm-hmm.
Hopefully never pass.
And I had one more question, and
sure.
This is a softball, but are assets in a revocable trust subject to the estate tax limit? And
absolutely yes.
Yes, that's the answer. So what Harry was proposing and going through the slat, it's an irrevocable trust that happens to be a grantor trust. So it's different from the revocable trust that is a grantor trust.
That's correct.
Yeah.
If any other questions, or if not,
I think that's it, Harry.
All right, that's great. Well, I thank you, Jill. Thank you, Dave. Thank you, Kemi. Thank you, LSL. It was great being here with all of you. I hope everybody walked away with a little greater knowledge and the understanding that it's a little time to take a good look at what to do. All right, guys.
Just wanted to let you know we posted Harry's contact information in the chat and also here. Please note that his email address is not a typo. Brent works very closely with Harry, so you can reach Harry through Brent. And also remember, you will be getting a link to the recording to this presentation sent to you later today, and you'll also have Harry and Dave's contact info. So we encourage you, if you have any questions, please reach out to your LSL advisor or to Harry. And with that, we will let you get about your day. Thanks, everybody, for coming. Make it a great day, and we'll see you next time. Thank you, Harry.
Thank you. Bye-bye, everybody.
Bye-bye.